Hey guys, Mike here. So finally showed some weakness in the market, which I was telling members we are definitely in the window to do that, as we talked about Nvidia and stuff, selling off after earnings. We'll see if that's going to be the case again tomorrow. We'll look at all that stuff, set it up. We are going to talk about Nvidia today in this video because one of you asked about it, so we'll cover that. Also, we're going to talk about Cem Karson's latest prediction when you asked about that. Also talk about gold, went into real estate, all kinds of fun stuff. But I hope everybody's having a good weekend so far, and I hope you have a great 3-day weekend. Remember, the market's closed on Monday, so enjoy it. Kiddos should be out. But I definitely want to start off with this. Let me ask you a question honestly here, okay? Remember, when all of a sudden we had to start paying back student loans, delinquencies, 90-plus days went through the roof. And so if you had to guess an age ranges are usually from 18 to 29, 30 to 39, 40 to 49, all that stuff, right, in 10-year increments. So if you had to guess the age range that would be the farthest behind or had the biggest increase in 90-plus day delinquencies, what age range would you guess? And put it in the bottom of the comments. Pause the video if you need to, okay? But I want to hear this, and we'll get into it. But here's how the consumer, being us, are faring. And it's not as bad as you think, to be honest with you. And this comes out quarterly. So this is why I don't talk about it very much. But you can see total balance delinquencies. It's going up, right? The curve is up. There's no doubt about it. The last 2 quarters, seeing a nice little jump there. Again, the people who are 90, 120 days severely, in delinquency, like their credit scores are so screwed up, so they'll be suffering for years. If this is what's happening, and that's just the way it is. So that'll affect them later on. They'll be paying interest rates, at the nosebleed rates for at least 1 to 3 years for sure, till they can fix their credit, no doubt about that. But again, when you kind of look over, you say, wow, we've almost reached right over there, back in like 05, 06 area, 07 area. It starts to creep up. Again, I'm not predicting that at all. Okay, I'm just saying, definitely curving up. That's the way the trend is going right now. Okay, if it was a stock, you'd say, wow, that thing's really going up good. Now, percentage of balance, 90-plus days delinquent by loan type, you can clearly see there are 2. Student loans, boom, went from 0, popping up right there. And then, of course, credit cards, which we shouldn't be surprised about. But when you look back, it's always like, what levels are these at? And credit cards are getting up there. But again, we use a lot more credit cards, right, than we did even back in those days. They're much easier to get, okay? When you look at HE revolving credit, auto loans, mortgages, no problems, okay? No problems at all. When you look over here at number of consumers with new foreclosures and bankruptcies, it's minimal. I mean, seriously, compared to the past. And why? Because most of us are setting in 2 to 3% mortgages right now. You shouldn't be in any issues, okay? If unemployment starts to tick up, that's when you're going to see all these numbers start to really climb, okay? There's no doubt about that, but you can see, and that's what what you're looking for right there. But you can see it was a whole different housing market back then. That's why you saw the craziness you got back then that you're not getting right now. Then we transition into the serious delinquency. It was 90-plus days for auto loans. And the one thing you'll notice here, 18 and 29, this is normal for them to be leading the way. You'll hear people say, oh my God, the younger generation, blah, blah, blah. It's normal. Why? Because they ain't making that much money, so it don't take much to fall into delinquency. Then you got the transition into the 90-plus day delinquency in credit cards. Again, you see 18 to 29. Now, it is interesting, again, on all of these auto loans, whatever you're looking at here, looking back in 2005, 2006, it's at those levels already. It is getting up there. And again, there's 2 different kind of economies. We know this. But this is the one that blew me away. Transition into serious delinquency 90-plus for student loan by age. I thought for sure it was going to be 18 to 29. Nope. Ended up being 50 plus. And I'm like, am I reading this right? Like, that is 50 plus, right? I'm pretty sure that's what we're looking at here. Yeah, 50 plus. I couldn't believe that. I was like, man, not 30, 39, not 40 to 49. They're second. 50 plus. Did you guess that, by the way? In the comments, I'm just curious because I would have never guessed that. Because I would have never guessed that in a million years. And so that's the stat of the day right there, stat of the week, stat of the year, whatever it is. That was really surprising. I don't know what that has to do with. I can't even make sense of that in my head, why it would be that way. Let me know in the comments if you can make any sense of that. But getting into the questions here, and again, is there delinquencies? Yes. Are delinquencies rising? Yes. Can't even ignore that. It'll come out every quarter. We'll see it, no doubt about that. Again, 2 different kind of economies. There is a lot of stress on folks out there in the economy. There's the haves and the have-nots, the ones with appreciating assets, they ain't enjoying any of this, and the ones with unappreciating assets, they absolutely can't stand any of it. And then the younger generation who's mad at the world because they're basically screwed because they can't buy a house, and if they do buy a house, they're going to be drowning in debt along with their student loans. So, don't blame them. We'll see how that works out, okay? Now, next question says, are there any updates from Cem Karson? I was wondering if he still thinks there's going to be a major crash starting at the end of the year, I believe, and then extending into first quarter of next year. There's been quite a few updates, but he did one recently this week, which I'm going to show you, and I've tried my best to edit this down because he does get to talking a lot, and this was a long podcast he was on, but I'll try my best to edit it down to what you're asking for and things like that. But he does, I think he makes some very good points, and one also admits that they were wrong in their thinking because of 3 reasons.
Yeah, so let's clean up exactly what we were saying and where we are. I think that's important. So one, expected that decline and called it, almost to the day in February. We thought it'd be about 15%. It went down as much as 22. We also prior said that 15% decline we thought was coming Feb to March would likely end up with a rally back towards the highs or even maybe a minor new high. And then we said, look, come the summer or the fall, we would, based on what we knew or thought at the time, we would likely see a retracement from those levels, right? Because topping is a process. That would be a bigger decline that could lead all the way till March or June of next year, which could be a much bigger decline that would go even below those lows. That was our view. By the way, been fortunate enough to kind of get the turns quite right for several years now. The rally back has gone further than we thought. There's no question about that. We thought it would probably stop somewhere between 6,000 and 6,350 in the S&P. And here we are at 6,450, 6,500. And where do we think things are going now? Several things. One, I think we underestimated the amount of liquidity and how quickly the administration would provide that. The shortening of duration on the Treasury side has been dramatic. That's been silent QE, and liquidity has been fairly dramatic. Two, we thought, quite frankly, that the Federal Reserve would not come under the administration's umbrella, given that, yes, they would take the chairmanship, but how do they get the rest of the governors on board? And in theory, you would, if you give a Nixon analogy, you would need some type of recession to stimulate or to justify just stimulating the way that we're talking about now. Largely, that was not correct, right? I think that's pretty clear now. Just this week, I think we got, final kind of reality that not only has Trump now taken over at least 3, if not 4 of the 7 governor rules, which also, by the way, control the regional president's reappointment or replacement. So, again, a full takeover of the Fed is now in process. But importantly, we also have gotten now at Jackson Hole a clear reversal of the Fed's inflationary mandate to control, which, by the way, we called for several years ago, but this is happening quicker than we thought, completely abandoning that 2%. Yeah, way sooner than we thought. We have also said for forever that the market is a weighing machine in the long run, but it is a voting machine in the short term. And if you want to call what I can tell you is what's going to happen with confidence in general in the next 10 years. I can also, call turns based on liquidity, but liquidity changes quickly, and the factors that drive it can change in meaningful ways. And one of the first things I'll always tell people is, cannot be dogmatic, and you have to be water. This idea that you have to watch liquidity, you have to see how things evolve, probabilities change as you move forward, and a lot of that is based on measuring supply and demand, how that's changed. Quite frankly, the amount of demand in this economy, and not this economy, in this market, which again has been driven by both the Treasury and now the taking over the Federal Reserve, is very hard to fight. We can simultaneously, and this is hard for people to think about, say we are at record valuations, and it really is not a question at this point. We are above most valuation metrics from the 2000 top and the S&P, which is the highest valuations ever. And being at those valuations are insane. I want to be clear. And, in 2020 and 2001, 2002, having been at the center of those markets, I thought no way in my lifetime would we see that kind of bubble happen again. Like literally, again, that was a 25-year-old Cem, right? Naive maybe in some ways. But what's changed, there have been dramatic changes to market structure. One, reverse repo, all of the new facilities that came out of '08 have provided the tools for government to do provide almost unlimited liquidity, right? The move to a much more activist Federal Reserve with much bigger tools, and obviously the centralization of power in the executive branch, its ability to pull these levers as much as they are doing. Those things are huge. Never mind the increase of volatility products and the structural product issuance and the vol compression and all of the structural mechanical demand that keeps plates spinning. This is what leads to, right, market number go up in the face of really fundamental, gravity valuations, which don't make sense. So both of those things can be true at the same time. We can say, look, given where interest rates are likely going, given the inflationary outlook, given the valuations, this is a bubble. And it is a bubble. There's no way that anybody can convince me that this is not a bubble. You would have to convince me, first of all, that 2000 was not a bubble. And then you'd have to convince me that, that the risks facing us are less than that moment to begin with. This is a bubble. But you can believe it's a bubble and also believe the liquidity, the voting, you have, again, a weighing machine, a voting machine, that the voting machine is so geared, so weighted to the demand versus supply that this bubble will not end here. And the reality is, we had a bubble in 1998. And then the market went up 50% before, the NASDAQ dropped 92% and 95% of tech companies went bankrupt. And so the question is, how does the bubble end? It always ends, almost always ends, with the fastest move at the end, with the most convex move before the opposite. And so, if you're asking me of probabilities of outcomes, given the dynamic that we're seeing, that's where we are. And really hard for people to say, okay, you're saying down, but then you're saying up. What I'm saying is up and up fast and high probability of fat right tail before left tail, and a megaphone of increasing volatility as we get there.
And so clearly they don't think that anymore. Things have been pulled forward. Things have moved forward, like as far as like where rate cuts are going to be, QE. And that's the thing you can't guess. Like every time you try to do logic and say, oh, the market should go down here. Again, if you teach your kids anything, I swear to God, they're going to go to school, tell them to learn, tell them to pass their test, but you also tell them when they take finance courses. I took them my associate's degree, my bachelor's degree, and my MBA. I'm telling you, remember, most of the books are written by the professors, okay? They are not in the real world. They are in academia, okay? They are not going to go on those courses, as far as I know, it ain't changed, and learn about liquidity and the government owning the market and the government running the market and all this influence they have over the market and all this stuff. They're not ever going to learn that, okay? And so you have to stress it to them. That is the stuff you can't predict. So when you're sitting there going, I don't understand why these stocks are going up. Here you go. It's just how it works. Liquidity is king. And I've been telling you for months and 5 years that I had this channel when I discovered that stuff, because nobody taught me that in MBA and my MBA finance classes and stuff. So you have to learn it in the real world and do your own research, okay? But that is key. So obviously he's not expecting some crazy crash down right now. He's not expecting to extend in the first quarter, as far as what I can tell. And so are we in a bubble? He said, yeah, but that's what I keep saying. Like 98, we're in a bubble. Went up 50%. You cannot predict the top of it, right? And so things have changed with the zero DTEs, these leveraged ETFs, all this stuff. You don't even need a lot of inflow into a stock now to move at 10 billion in market cap. You know what I'm saying? So it's very interesting, but also that makes the downside when it does come down, it comes down fast, right? So, that's what you're watching out for. So anyway, hope that helps right there. Next one says, what are the charts showing for Nvidia now that it has reported some incredible earnings? They were absolutely incredible. As you always say, the market will go as Nvidia goes. You kind of saw that yesterday as Nvidia went down. market drained down, market came down, didn't get a bounce. It's pretty simple. I mean, look, it's sold off, as I talked to you guys and showed you or showed the members, over the last 3 years after earnings, it sold down. Okay, about 17 to 20%. That puts you anywhere from like 144 to like 150, somewhere in there, which would be a great bounce area, right? I mean, that would be one of those previous levels, which was resistance for a while, then became support and all that fun stuff. And we'll see if that's going to happen, right? You know, you think we're in this September area, which, you know, you show this weakness and stuff of a window leading up to the Fed rate cut, you know, but it's going to be up and down. I don't think it's going to be straight down or anything like that if we get it. You know, and of course, what you want to look for is that break of the 50. That's what you want to look for. And so that will be tested here. You can see a bounce maybe coming back up, and then maybe get a drop for the rate cut or after the rate cut. Again, there's a 200. When you go back and look at the past, you look at 2024, great earnings, right? Boom. Down we go, break the 50, go down about 20%. Okay, and then it goes up from there. All right, that's something you'd love to see, because I'd rather buy Nvidia down there than where it's at now, wouldn't you? Right, any stock for that matter. You know, you see 2023 gets a good pop the day after earnings, drops down, comes back up, and then we end up getting a nice sell down. Okay, around like 17% at first, it bounces, and then we take off from there. 2022 is in a crash, so of course we sold back off after that, bottom in October. So yes, I mean, it makes up 8% of the SPY. I forgot, what is it, like 12% of QQQ. So that's why, and plus when it's going down, it's usually dragging the other semis down with it, because it is the AI king. And so, you know, that's what I'd be looking for. Those levels, if it does come down, I mean, you can almost bet money it's going to get bought up for sure. And when you look, when we pull up like the visible range volume profile, you can see if it breaks the 50, it has a really good chance of coming down to that area. And the reason why, there ain't much support. It just isn't. I mean, you pull this out right here and you can just see a big volume gap there. So once it breaks that 50, you can see there's a clear move down into the like 149, 150 area, maybe even 144, somewhere in there. So, you know, don't want to argue that. Plus you got like a nice imbalance there as well, which we'll mark out. So that would make a great bounce point for it for sure. And, you know, going back to what Jim said, I mean, you know, everybody thinks this is the burst of bubble here. And again, you can't predict that stuff, but it's like, I think we're in like phase 2 or 3 right now, but we'll see. Next one here comes from Richard. It's a lot of different questions, a lot of good questions. So what we're going to do is break down all 3 of these, because they kind of cover different things here. And so when we look at the first one says, do you think real estate small caps, I think it's supposed to say IWM right there, and financials like SoFi will be the most heavily affected by rate cuts next month? I think the easy answer is yes. And that's why you're seeing financials run, obviously small caps. So if rates do come down, let's say they cut 3 straight, months in a row, 3 straight meetings, excuse me. You know, remember these companies on IWM, they got to take out a boatload of debt. They've taken it out way up here, these rates. They can refi, and not that really what's going to move the stocks anyway. Let's be real about that. But it does. It's QE. That's just what it is, and that affects them the most. SoFi, that means it's going to start rolling in. People trying to refi the student loan debts. I get those emails every day. Am I the only one? I mean, oh my goodness, got to start blocking them. They're insane amount. And of course with everything, and plus usually people say, well, rate cuts that'll affect crypto as well, which SoFi's into. They're into all kinds of stuff. Obviously, real estate. You would think, one, refis are going to go up for sure. 2, it depends on, and we'll talk about this more in your next question, obviously supply demand, but if you drop the rates, you would think it's going to increase demand even for home buying, okay, not just refinance. Now, the second question here says, I've been involved with property development for 30 years. There is nothing normal about the real estate market. I could not agree more, especially since COVID and the quantitative easing and interest rate drop that followed. There are a lot of developers out there who thought they were geniuses by going deeply in debt by building into what should have been a recession. I correctly called the 2008 crash within 3 months and made a killing. From what history shows me, we were poised for a significant pullback in 2019, 2020. Inventory was building and interest rates were rising. COVID stimulus and some questionable government data on recession kicked the can down the road a few years. I don't see how this is sustainable. A pullback would have been devastating to some, but healthy for the market and inflation. Would you agree that the 2 biggest factors in home sales, any asset, are money supply and interest rates? If you track money supply, the trend correlation in price and sales is consistent. Well, since you've been in the business for 30 years, I'm not even going to argue with the real estate part. Definitely interest rates, definitely QE, money supply. But also because it's a house, right? I mean, to me, like the money supply is way more effective when it comes to stock market, crypto, things like that. But when it comes to like houses, don't you think it's more supply demand? I mean, isn't that what we really saw? Like as home prices got too high, demand fell off a cliff. And of course, when rates came up, demand fell off a cliff, right? So prices have been steadily kind of declining here because people can't do what? There's no bidding wars, right? So if interest rates get cut, and all of a sudden, and you know this, every market's different. You have some hot markets, some are not hot, no matter what's going on. But, and all of a sudden interest rates start dropping and demand starts to kind of pick up. Well, now all of a sudden, if you're the one selling the house, you're not going to be like, I guess I'll cut the price, and that person says, well, I'll give you, 2% over he's asking or 10,000 over or whatever it is. You're going to take it, right? And that's increasing prices. And I agree with you totally, by the way. So that's why I look at supply and demand when it comes to real estate, but could be wrong on that. But when it comes to what you're saying about 2020, I'm like you. I don't know. I don't get how this is sustainable for the longer term. I don't get it. But it just seems like too many people are priced out. Even if you drop the rates, that's not going to drop the prices. It's crazy to pay, especially in my area, $500,000 for a 3-bedroom, 2-bath, middle-class home. That's insane. When it was just 5 years ago, $275,000. It's nuts to me. I appreciate it. I'm happy it went up. But it just doesn't make any sense for the long haul. So, because the gains you're going to make in the future, it's like, it's got to be minimal. What do you tell me? This house I live in is going to be worth $1 million for a 3-bedroom, 2-bath, middle-class home? Like, really? Eventually, I would think there's going to be some shock to the system, and you really need it in a way to get it going. But that's just me. I've been saying that. I've been saying it for like 2 or 3 years, and it hadn't come true yet. So I'm gonna just keep being wrong on that one. Now, Lasner says, would you also agree that having AI controlling much of the stock market, government's economic decisions, and Fed policy is dangerous and can lead to consistent money printing and inflation? And the answer to me is absolutely. Now, as far as the inflation part, I'm not even going to try to predict that part of it. Now, do I see a consistent 3%? That's like the new norm? Yeah, for sure. No doubt about it. But as far as, always having QE, and you do not want one political party controlling the Fed and all monetary policy. Because you may enjoy it while your team's in control, but it never fails. The pendulum will swing. And when they start trying to remove Fed presidents for cause and doing this and trying to get their hands on it, they're going to say, you see this pendulum? You put it way over here. Watch this right here. Boom. And then you go, whoa, I don't like that. Oh, yeah, that's what I got for you, Richard. Let me know your thoughts on that and everybody else's thoughts. Next one says, hey, Mike, really enjoy all the analysis. I was wondering if you can analyze the gold ETF, GLD. There has been a lot of talk about using it as a safe haven because people seem terrified of the current U.S. government debt situation. Maybe you could talk on that a little bit as well. I've also been hearing talk about going into energy stocks because of the needs that AI will have in the future and also precious metals. In general, do you see the same demands that will persist into the future? Thanks. When you look at GLD, first of all, obviously breakout from that trend line, explosive move up. So big move in gold here. And actually it has like one of my favorite patterns here forming at the top where you see us getting these higher lows, but it's just stuck right there and it's just knocking on this door. So if it breaks through, it's going to be probably a really nice move up. And yes, people are using this as a safe haven for sure. I know I had some member tell me he bought gold calls yesterday morning, I believe it was. So, if it breaks above that, there's no resistance, right? That would be a new all-time high for it. So, again, you can see when this thing breaks, when it goes, it's been doing really nice for people. So, yeah, I can definitely see that for sure. You kind of see the same pattern here and had a nice explosive move up. So, and it's funny, I heard people say, well, I use it as an inflation hedge. I'm like, really? I don't even understand that part of it because inflation has been coming down. That's inflation right there. And this thing's been going crazy. So, it's like, I don't know. I understand maybe when inflation was crazy high, but no. The other thing to watch out for is going to be the dollar, of course. That's really the big one because the dollar is doing the opposite, right? It's in lower highs. So if the dollar breaks down because they have an inverse relationship, then obviously this thing is definitely going to bust through and go higher. That's what you're looking for. And if it breaks through, it'll probably come down to like, what's that, $96 to $97 right there, somewhere in there. So if a dollar breaks, then yeah, that's going to happen for sure. As far as energy, yeah, I've read the same thing you're reading. The energy bills are going to go through the roof. They're already going through the roof, okay? And we ain't even built nowhere near, what they're talking about when it comes to capacity of these data centers and stuff. So, I can't wait to see that happen. It's going to be really great, right? So, I think going to the right ones is the case. Obviously utility companies, GEV is another one that's very popular for that. It sells the parts and everything. But, I've seen the same thing, nuclear, all that good stuff. So, going to need it all, really, when you think about it. So, but if we start really, cracking down on one part of it, like we take away solar and we take away wind and all that stuff, then that puts even more money going into this other side because it's going to have to pull more weight, right? So that's kind of where we're at on that. So I definitely agree with that. There's no doubt we're going to need more energy, and unfortunately, we are going to pay the price on that as well. That's why they were trying to like push through in the big beautiful bill that part about somehow being able to put these plants like near residential areas and all kinds of crazy mess. Not to mention the amount of water it takes to do it and stuff. And then one of the representatives from Kentucky, he's the one that sounded the alarm on that because I guess they had to deal with it in Kentucky. So I appreciate him for that. So anyway, hope that helps, guys. Really enjoyed answering your questions and stuff. Feel free to put more questions for next week's video in there. Hope you enjoy your long weekend. Please hit that like, subscribe button on your way out. Thank you for signing up for the membership. Less than McDonald's combo at $7.99. Just hit the first link in the bottom. That's everything you get with it. And I'll see you guys